different considerations that then we can review the guidelines. And again, this is not an all-inclusive list that I'm bringing up here, but again, this is about establishing the thought process. This is a methodical process where you're dissecting the loan, right? And basically each section is being treated as an individual section. And then in the end, you connect all the dots and see which is the best guideline to allow you to meet all of these different sections. So first, obviously, is if the property is a purchase or refinance, then you have seasoning requirements, right? Besides the value of the property and all that, that has nothing to do with guidelines. Guidelines is seasoning requirements, right? If it's an FHA loan, remember the FHA 90-day flipping rule. You can't get into contract until day number 91 of an FHA loan where the seller is reselling the property, a property that they just purchased. Day 91 is when you can legally enter into a contract. If it's a cash out refinance, another consideration is using the appraised value versus the purchase price plus renovation. That's another seasoning requirement. Cash out seasoning, that one is really all over the place on non-QM. Fannie and Freddie, it's set by the guidelines. FHA set by the guidelines. There's no overlays on that kind of stuff, right? The overlays, all that they can do is make it stricter. They can't make it looser, right? That's what overlays do. They tighten up certain parts. But here, now another consideration is when it's a purchase or a refinance, are you going to be required a CDA or a second appraisal? That's for non-QM. That could be a deal breaker. You got that transferred appraisal already on a deal that you got, and you already checked your AVM, and the AVM works out as your secondary valuation source. You got a good deal right there that you can close. They got denied somewhere else. You're going to put it together as a bank statement loan. It was a full doc before, but you want to make sure that you don't submit it. If it's a large loan, you don't submit it somewhere where it's going to require a second appraisal. And then the second appraisal comes in lower, and now your deal is dead. So again, guidelines. Property type is another consideration. Is it rural? Wow, isn't that one of the topics that can really kill a deal? And that's not always so easy to determine. Sometimes it's pretty easy to determine when you're reviewing the property's profile, but other times it's not, and it's strictly up to the appraiser. Does the property have ADUs, accessory dwelling units, right? We got DSCR programs that allow one ADU, but not two ADUs, and certainly not three ADUs. We just had one like that the other day, right? Single family home with 3 ADUs. Is it a non-warrantable condo, right? Does it have limited reserves? No, not enough reserves. Does it have too many renters? The renter owner ratio is too high. Those are factors that can easily be resolved either by a limited review condo or, depending on non-QM, different guidelines. We have guidelines on our non-QM for condos that do not ask for a condo questionnaire. They don't review reserves. They just ask for certain basic items of litigation and more than 15% of the unit owners 60 days or more delinquent, and that's it. So that would be one way to resolve that objective without going down this rabbit hole and not being able to find your way out, right? Pretty easy there if you know the guidelines and you review them. And then also property condition issues, right? You're here thinking, oh yeah, I can I can escrow for repairs in this loan, and you base everything on that assumption, and now all of a sudden, underwriter says, hey, your appraisal here is as is. There's $8,000 in repairs here. This is going to have to get taken care of before you can close. And here you were thinking, oh, I thought this had a repair escrow feature in this loan. You would have to find that out in the guidelines or in any overlays. Credit considerations, right? The obvious credit score, but also number of trade lines, no housing payment history on a borrower. That could be a big one there. or credit events. What are credit events? Bankruptcy, foreclosure, short sale, deed in lieu, charge-offs, collections. Those are all credit events, and different guidelines treat them differently. We have guidelines where if you have collections or charge-offs, but you have enough reserves to cover those collections or charge-offs, we don't even have to consider them, and they can remain unpaid. Now, that's typically found non-QM. Now, sometimes in AUS, you're going to get an automated underwriting approval on a primary residence where at a lower LTV, that'll let you leave charge-offs and collections unpaid. We've all had those as well. But on non-QM, you're going to find that out by looking at the guidelines. No need to run it through AUS to see if it'll give you that break. Other considerations, borrower, right? What type of borrower do you have? Is it a U.S. citizen, permanent resident alien? Sorry, I spelled that little typo there. Or non-permanent resident alien. Those are all, I would consider, the same category of borrowers in that they are legally authorized to work in the U.S. They have legal status to live in the U.S. They could all get all the same types of loans: conventional, FHA, USDA, VA. You got to be a veteran or active military. Is your borrower an ITIN borrower, right? Working here in the U.S., living here in the U.S., doesn't have legal status, has U.S.-based credit. Are they a foreign national borrower? Are they a first-time investor or a first-time buyer? Those are all important considerations that could totally make or break your deal, especially in the non-QM world. That is a biggie. And then income considerations. Is your borrower salaried or hourly? If they are salaried or hourly, is there any variable income component like overtime, bonus, commission, or tips, to name the four most common variable income types? Are there any income gaps on your salaried or hourly buyer? Remember, any income gaps more than 30 days or employment gaps more than 30 days have to be documented, explained, and the underwriter has to accept it. So you could get an automated underwriting approval with a 4-month income gap, and then the fine is going to tell you provide documentation for any gaps greater than 30 days, and the underwriter is going to have to decide if they want to do that. For your self-employed borrowers, is it full doc or alt doc, right? That's the key, and you're not going to know that until you review tax returns, or maybe the borrower already told you, Jose, I haven't done tax returns in 3 years. Everything's on hold. My accountant's working with the IRS on all that kind of stuff. I have some unpaid tax liabilities that I'm trying to work down. So that's not going to be a full doc borrower where you're going to have to provide tax transcripts, record of account tax transcripts that's going to show that they owe taxes, $20,000 in taxes that they don't want to pay because they're working with the IRS with their CPA to get that amount reduced. So again, full doc or alt doc. If alt doc, are you going to go bank statement? Are you going to go P&L? Are you going to go asset utilization? Are you going to get full doc and add asset utilization? We have that in non-QM, and we actually have that in more restricted versions in agency as well, right? For 62 years and older borrowers that have a substantial amount of savings, you can add asset utilization to your W-2 or fixed income. Didn't you know that? And for non-QM, we could do that too. We could combine W-2 income with asset utilization. We can combine W-2 income with bank statement and P&L and asset utilization. If you have those 4 different income streams separately accounted for, we could actually do that. And if all else fails, DSCR, right? And we all know the DSCR rates are coming in strong. And it's not just about the rates either. Remember, it's everything else. And it's not just about the no income. It's things like no seasoning options, short-term rental income, and other factors beyond the obvious that allow the DSCR programs to really shine like they do. And lastly here, assets, right? Our last area that we're going to consider is assets, and very important, right? Because if you can't have the funds, if you don't have the funds to, verified to close, you're not going to be able to close. And different considerations are seasoning of the asset, right? How long has it been in the account? Some options require 60-day seasoning. Others require no seasoning because other options, some of our non-QM options, don't even require sourcing of large deposits. As long as it's in the account and it's not like a $240,000 deposit or something like that out of the ordinary, but just normal deposits, they're not going to question them. They may ask for an unusually large deposit just to make sure that it's not some kind of debt or something. But normally, our non-QM options give the best guidelines for seasoning and sourcing. Gifts, something else to consider. And if there is a gift, you got to know, because you got to help them structure the gift so that it's transferred from the donor to the borrower in a manner that's acceptable for the program. How many times have you seen they gave the gift in cash? Oh, yeah, I got a gift from my dad. Oh, yeah, sure. Let me see the documentation. Well, he gave it to me in cash. Okay. Did he pull the $5,000 out of his checking or savings account or mutual fund and then give it to you in that way? Gave you the cash that he withdrew from his account. So then you could track at least, hey, there's $5,000 withdrawn today. Here's a gift letter and it was deposited in your account. But then the answer in those cases is not going to be that. The answer is usually, yeah, no, he just had some cash lying around and he gave it to me. And in that case, then that gift can't be sourced, and then you're going to have to wait for that money to season in the account before it can be considered for assets and before it can be considered for reserves, because reserves is another requirement, especially for non-QM, especially for DSCR and bank statement, all these alt-doc loans in non-QM. They're going to ask for a certain number of months. It could be 3 months. It could be 6 months. It could be 6 months plus an additional 3 months for every property that they own. So again, there's a lot of different options that you could find regarding reserves. And that's because, again, like I mentioned, all non-QM guidelines are going to be specific to that investor and their secondary market needs. So whoever they're selling their paper to says they got to do, that's what they're going to tell us, and that's what we're going to tell you. So again, you saw here what we've done is we've established the thought process, why guidelines are important, how guidelines can differ, and then what are the different categories of the loan that you can look in the guidelines to try to get the guidance from the guidelines that you need to properly structure your loan.